And I won't be having you do the payroll register, but in 4.9 you'll be recording the employee payroll journal entry. So for 4.1, if you see here, let me pull that up. All right, so in 4.1, what you need to do is calculate the taxable earnings. You'll be given different situations. If you look here, in number 1, you're given the gross pay, the cafeteria plan. Both are given, and you just subtract the two to find the taxable earnings. In this case, you had Evan Carter earning the $16.25, as you see here. He contributed 9% of pay to a retirement, and then he gave the pay to the cafeteria plan. But in this case, we're just subtracting the cafeteria plan. And number 2, we have Teresa Henry earning a gross pay, contributes 8% to retirement and 4% to the dependent care flexible spending plan. In this case, we just take the gross pay. We find the dependent care flexible spending plan by multiplying gross pay by 4% that's given. Subtract that to find the taxable earnings. Number 3 is the same way. The flexible spending account is given. If you see number 3, that's given here. Since Candice Mann contribute $50 to flexible spending account, and you find 4% for the dependent care flexible spending plan to get a taxable earnings of $790. And in number 4, we're just given the gross pay. We're not calculating the 401k, so we just take the gross pay of $965, and that would be your answer for that. So the next problem I wanted to discuss is from 4.5. Just want to look over a few things. So you have to respond in certain ways. There are different definitions, as you can see here. If we look at 4.5, for each voluntary deduction listed, write a definition. So here's some various definitions you could probably write out. See here, I would find them in the book. And then for 4.7, when you're populating employee earning records, I won't be going each employee, but in this case, what I'll be doing is just kind of discussing how to calculate the Social Security tax and whatnot as well. So here, at number 1, we have Ronald McCarthy earning a gross pay of $925 on the left here. Each period he makes a 401k contribution of 6%, and his current year taxable earnings for Social Security tax is $29,500. So if we look here, we have a gross pay of $925. We multiply that by the Social Security tax of 6.2, and we get $57.35. In number 2, Jill Newton. Look in this problem here. Jill Newton earned a gross pay of $2,255. She does not make a retirement plan contributions, but her current year taxable earnings is $132,650. If you go here, you'd have to take the $132,900 Social Security tax threshold. I'll zoom that in a little bit to see that a little better. So look at number 2 here. We minus that by the taxable earnings that's given here, $132,650. We multiply that by the 6.2% Social Security tax to get $1,550. In number 3, George Thomas earned a gross pay of $25.75. Each period he contributes 4% to a flexible spending account. His current year taxable earnings for Social Security tax to date are $103,750. So in this case, I'll take the $25.75 gross pay. I minus that by the gross pay times the 4% flexible spending account contribution that's given here, and you multiply that by 6.2%, get the Social Security tax. And for number 4, if you notice it says here, Jeffrey Stockton earned a gross pay of $2,775. Each period he designates 8% of gross pay for dependent care flexible spending account. His current year taxable earnings for Social Security tax to date is $223,500. As you see here, that amount, the year-to-date taxable earnings exceeds the Social Security tax wage base. So there's no amount listed. Next, I wanted to cover Medicare tax. There's a few examples here that maybe some of you at home. Number one, you have Mark Daly's filing status is married, filing jointly, and he has an earned gross pay of $34.50. Each period, he makes 403B contribution of 9% gross pay. His current year taxable earnings from Medicare tax to date are $312,500. So we go to 4.3 here. Taxable earnings is 3.450. That's given. And to find the Medicare tax, we just take that and multiply by 2.35%, as you see here. Hopefully that you can see that for number one. Okay, for number two, Kurt Blaine down here. Kurt Blaine, filing status is single, and he has earned a gross pay of $1,950. Each period he makes a 401k contribution of 8% and contributes 4% gross pay to a dependent care flexible spending plan. His current year taxable earnings for Medicare tax to date are $199,225. So I go here, that's given $1950, right? Flexible spending plan is 4% of that to get $78. Then we subtract that amount to find the taxable earnings, 1950 minus 78, found by multiplying 4%. To find the portion of the taxable earnings below the additional Medicare wage base, we take the $200,000 number and we subtract that by the $199,225. That's the current year taxable earnings for Medicare tax to date here listed here in the problem. Then to find the portion of taxable earnings above the additional Medicare wage base, we take the $199,225, add the 1,872, which is the amount of taxable earnings if you go back here, up here. Then we subtract the 200,000 to find the portion of taxable earnings above the additional Medicare wage base. Then to find the Medicare tax, we take the those amounts. 775 was the portion taxable earnings below. You see there, multiplied by 1.45%. Then we take the portion of taxable earnings above the additional Medicare wage base, 1097, multiplied by 2.35%. Add those two, and then we get 1097. So now we take the 775. Yep, so that's the value that we come up with for the problem. That'll be complete 3702. So we go down to number 3 to look at that problem. Adam Webster. Adam Webster's filing status is head of household, and he's earned a gross pay of $850. Each period he contributes $35 to the flexible spending plan. His current year taxable earnings for Medicare tax to date are $75,500. So look at the gross pay that's given here. But the spending plan is also given. To find the taxable earnings, all we do is subtract those two amounts, gross pay minus the flexible spending plan. Then we multiply that by the 1.45% rate to find the Medicare tax. For number 4, as you see here, right? Hopefully that helps. You can see what is what for the answers. You can kind of look at the numbers that were calculated for this. So what we have, Keith Davidson, filing status is married, filing separately, and he has earned a gross pay of $2,200. Each period he makes a contribution of 12% gross pay, contributes $125 to the cafeteria plan, and then his current year taxable earnings for Medicare tax to date, $222,700. If we go to number 4, the gross pay is already given, $2,200. Cafeteria plan of $125. I apologize for that. That's here. Yeah, both are given. Find the taxable earnings. We subtract those two. And the Medicare tax, we take that amount, multiply by 2.35% to get $48.76. Okay, last but not least, I want to discuss FICA taxes. That should help cover what's in 4.7. Yeah. So 4.7. I should have some FICA taxes you need to calculate. Okay, so FICA taxes. Number 1, Christopher Jones, filing status is qualifying widower, gross pay of $1,550. Each period he makes a 401k contribution of 8% gross pay and makes a contribution of 4% of gross pay to a flexible spending account. His current year taxable earnings for Social Security tax and Medicare tax to date are $249,700. So find the tax. You go to here, taxable earnings for Social Security tax, not listed. The reason for that is year-to-date earnings exceeds the wage base, which is $249,700. Social Security tax is also zero, since that taxable earnings base multiplied by 6.2% is still zero. Now we take the gross pay, that's given. To find the flexible spending account, we take the gross pay here, $1,550, multiplied by 4% to get $62. And then to find the taxable earnings for Medicare tax, it's $1,550 minus 62 to get $1,488. To find the Medicare tax, we take that amount, $1,488 times 2.35% equals $34.97. Okay, so Kevin Bird's filing status is single for number 2. We'll start with this problem now. He has earned a gross pay of $32.50 each period. He makes a 403B contribution of 11% gross pay, contribution of 1.75% gross pay to cafeteria plan. His current year taxable earnings for Social Security tax and Medicare tax to date $198,650. So go to number 2, right? Once again, year-to-date earnings exceed the wage base, right? Social Security tax, therefore, is zero as well. Well, we take the gross pay that's given, multiply that by 1.75%, as you see here, get $56.88. Then we subtract that amount to find the taxable earnings for Medicare tax. Then we need to find the portion of taxable earnings below the additional Medicare wage base. Subtract those two numbers, $200,000 minus the given amount of $198,650, you see here, current taxable year earnings. To find the portion of taxable earnings above the additional Medicare wage base, take $198,650, add the $3,193, which is the taxable earnings for Medicare tax. Then we subtract $200,000. After we find $1,843.12, that amount is multiplied by 2.35% here for the above portion above. For the portion below, we multiply that by 1.45%. Add those two numbers, and then we get 62.89 for the Medicare tax. For number 3, Daniel Higgs, filing status is married, filing jointly, earned a gross pay of $37.60. Each period, he makes a 401k contribution 12% and contributes $200 to a dependent care flexible spending account. His current year taxable earnings for Social Security tax and Medicare tax to date are $113,300. That's number 3. So the taxable earnings for Social Security tax should also be zero here since it exceeds the wage base. Social Security tax, therefore, will be nothing as well. But we'll look at the gross pay that's given, $36.70. The dependent care flexible spending account is also $200. So we subtract those two numbers to find $34.70. Then we multiply that amount by 1.45% to get the Medicare tax of $50.32. So that should be the solution for that. And last but not least, number 4, Bruce Miller's filing status is married, filing separately, and he has earned a gross pay of $3,200. Each period he makes a contribution of 10% from 3B, contributes $100 to cafeteria plan, and current year taxable earnings is $131,800. So if we look here for number 4, right, starting there, taxable earnings for the Social Security tax should be the difference between $132,900 minus $131,800, which is given. The $132,900 is a set amount from the Social Security tax. So therefore, that would be $1,100. That's the taxable earnings for Social Security tax. To find the Social Security tax, you take the taxable earnings for Social Security tax, multiply 6.2% to get $68.20. To find the gross pay, that's given, $3,200. To find the cafeteria plan, that's given here too, $100. To find the taxable earnings for Medicare tax, we take $3,200 minus $100, you get $3,100. And then the $3,100 times 1.5% to find the Medicare tax of $44.95. So that concludes the video for now. Feel free to ask me more questions. If we look at what's needed for the earnings record, I think, not earnings records, but 43 employees, that should cover it, I think. If you look here, right, so we look at an employee record here, you'd have to fill in the various slots, right? Regular hours worked, mostly the Social Security tax, Medicare tax, retirement contribution, that should all be listed if you have it, check number. And then after you find the deductions that I showed you with the FICA taxes, Social Security tax and whatnot, you'd be able to find the net pay by subtracting. Oh, one more thing. I also wanted to discuss the journal entry. So if you look at the journal entry that's likely to be given to you, in this case, we look at 4.9 here. Based on the following figures for all employees during their recent pay period, record the necessary journal entry, February 22, 2019. These are the various amounts. We have a retirement plan, tax payable, Medicare tax payable, Social Security tax, life insurance payable, federal income tax, state income tax payable, wages expenses, salaries expenses, cafeteria plan payable, Social Security tax payable, and charitable contribution payable. This would be an example of the journal entry you'd have to input, be a debit to salaries expense, a debit to wages expense, and then a credit to all the payable amounts. This would be a payment of salaries and wages to employees. So, well, that concludes all the video, all the items that should be covered for chapter 4, practice set A. Practice set C is very similar. Let me know if you have any questions. As usual, feel free to email me. Also, visit me on office hours, or if you want to set a Zoom time, always let me know. And thank you for watching.